Hello traders, this is Blake Morrow with ForexAnalytix and you're listening to the week ahead video for December 29, 2019. Can't believe that another year has passed, and matter of fact another decade has passed. Going on now my third decade of being in the markets. It's been quite some ride, and as you guys know, this last year has been very low volatility, but I think 2020 is going to be an explosive year for volatility, and it's going to give us all a lot of opportunities. So no better time than to be part of ForexAnalytix, the community, now. And you can try it. $1 for 10 days. Just sign up, try it, give yourself a New Year's gift, give yourself the opportunity to see new developments as they're happening. You can have all the analysis right on your mobile application. You know, whether you're using an iPhone or an Android phone, you can have all of our analysis right to your mobile device, being notified when new analysis has been uploaded and certain levels are being breached. It's a great New Year's gift for yourself, so take advantage of it. It's only $1 for 10 days, and it doesn't matter what pricing model you decide to go with, whether you want to do the premium model with the ForexAnalytix community, all the advanced analysis, or you just want the light analysis, which is only $20 a month, or $19 a month rather. It doesn't matter which one you choose to go with in the future, you will get the premium version while you're trying it out, and you do get the app no matter which version you're using. So make sure you try us out, and we're looking forward to having you part of this community in 2020. All right, so let's talk about this is the last week. Obviously we're going to have New Year's Eve on Tuesday night. Wednesday morning, or Wednesday, will be New Year's Day. Thursday we'll see some activity. Friday we'll see some activity, and there is economic data that's being released. But just keep in mind that we're probably going to have fairly low liquidity, like we have had for the last week as we went through the Christmas and Hanukkah holidays. It's been, it's been rather light. Markets have been grinding. However, we saw some pretty big moves at the end of the week, and mostly they came in light of the euro. Look at the euro and look what happened on Friday of this last week. We exploded higher and we closed well above the 200-day moving average and right up against really key resistance around that 111.80, 112 area. Now, I'm telling you guys, we've been compressed with the euro dollar for so long, with such little volatility, that if the euro breaks out, it's probably going to be pretty big, just from a lack of volatility, stops being triggered. There's a good chance that the euro dollar could explode higher. Now, does that mean that the euro could sustain a break higher? I mean, Europe's got its own set of problems, and I don't want to be dismissive of them. However, there's a lot of things that are going right for the euro, and a lot of them being that it's been a funding currency for a lot of risk on trades. And when you're talking about the stock market that is at all-time highs and closed at all-time highs for the week, if that starts to unwind a little bit, you could see some euro strength come through the market. I don't know if this is going to be the week, but I will say that the euro is at an alarming level if you are short. Now, it'd be the same conversation in reverse if the euro was down at 110 and it looked like the euro was going to break down. I really don't care personally which direction the euro goes. I just want it to move. And right now we're obviously threatening some really big resistance at this 112 level, and I got to imagine there's stops above there. Like I said, do I think that the euro could sustain a break higher? Yeah, I've thought it could. Back when we were up at 112 before, I thought when we were back at 111.80, a couple months ago, that the euro could break out. We are at threatening levels. Doesn't mean that it will break out this week, but with lack of participants around, there is a risk that in the low liquidity environment, that stops could get triggered and we could see an exponential move in a low liquidity environment. So if you're short, I just have to warn you, Be very careful here as we approach the 112 level. Now, it's not just the euro that's moving, guys. It's not just the euro. Now, I will say that the cable has been very much lagging. You can see that the cable pulled back basically to the flag breakout point at the one, it's like one, I think it was 128, 85 or something. We basically, retested that breakout point. We bounced, but the bounce is not equivalent to what you're seeing in the euro, and you can obviously see it in the euro pound. The euro pound has been, strong the last couple of sessions. Matter of fact, the euro crosses actually look pretty strong, which I'm not going to go into today. But what I am showing you is that you're seeing dollar weakness, not just against the euro. Look at the Aussie. I mean, the Aussie's testing the 78% retracement of, this move right here. We are well above the 200-day moving average. We are relative strength is getting a little overbought, but we are definitely moving in the Aussie. You look at the Kiwi dollar. We have, by the way, on the Kiwi, we have completed the inverted head and shoulder pattern. We are testing pretty key resistance right now, as it's a pretty key zone that is, affected and reacted from over the course of the last couple of years. So be careful with the Kiwi. But again, it's not just the euro. You're looking at, I got to show you the dollar Swiss. Take the dollar Swiss, look at the weekly chart, and what we don't have drawn out here, and I'll point it out to you. This is not my analysis. That's why I'm just going to point it out to you. If you take this low right here, back in back in 2015, low right here, we are actually below a trend line. So if you took a trend line and you drew it from here to here to here to here, we are actually below a weekly trend line for the Swissy. Pretty crazy, right? Then you take like the dollar Canadian also, we are below, and you can, let's see this, you can see it in pink, this little trend line here. Actually, let's go over to the weekly chart. You know what? Better I go over that, and I do it this way. Look at the dollar Canadian this way. Let the chart populate for a moment. We'll go back to that S&P chart. But if you take a trend line here, we have actually broken down this week. All right. Now, do I think that the dollar can continue lower across the board? Yeah, like I said, I do believe it can happen. Do I think it's going to be data driven this week? Probably not. I think that most of the dollar weakness is probably just going to be a broad-based dollar move, tripping stops. But it is a risk, and so if you are long dollars, you need to be aware that we're seeing the dollar break down in several different ways. Now, I wanted to point that out just because, like I said, it's a light week. You got a lot of people that are away from their computers. They're not going to be back until like if you think about this next week, they're not going to be back in front of their computers till the 6th or the night of the 5th. All right. So, this entire week, whether you're talking Monday, Tuesday, which is New Year's Eve, or Thursday, Friday, which is right after the first of the year, you're going to have a lot of traders away from their desk. So that lack of liquidity could bring a continued move in some of these dollar pairs. So that's one thing that we need to be aware of. Another issue that I wanted to bring to your attention, obviously, is the S&P and what we're looking at with the S&P 500. Let me go ahead and let the chart populate here. If you guys are longtime listeners of the FACE webinar, or what used to be the Morning Edge years ago, I always used to talk about the rubber band theory. And one of the reasons why I love the 200-day moving average is because the 200-day moving average is basically what you would assume. It's an average, right? It's an average, and it's what we would call the mean. And so we oftentimes revert back to the mean. And I always talked about a rubber band theory. When you stretch a rubber band too far, there's so much tension, it'll snap back, to its original form, or in this case, the mean. So whenever we get too far away from the 200-day moving average, you see a and let me move this out of the way. You see a snap back, right? You pull too far away from it, you get a snap back. You pull too far away from it, you get a snap back. Pull too far away, you get a snap back. Obviously, last year, at the end of the year, the market was just under some tremendous pressure at the end of the year, but we bounced back. We snapped back, and that rubber band just pulled back to the mean. Well, right now, if you look where we're currently at, we are pulled pretty far away. Now, doesn't mean that we can't go further, right? Doesn't mean that we can't go further here. Excuse me one second. And if you're looking at like the longer term Fibonacci's, we're looking at 161% extension that takes us up to 3,300, which we talked about. I think we talked about that last week ahead video last week. But excuse me, we're obviously a little overbought. Look at the relative strength. We're in overbought situations here, and overbought territory when you're talking relative strength. So you got to be a little careful that we might get a revert back to the mean. We might see that equity market snap back a little bit, and if it does, how does it affect the FX market? Well, that's when I start looking at the euro dollar, and let me go back to the euro here. And that's when I start looking at the euro dollar, thinking, well, if we do end up squeezing higher in the euro, it might be a result of just some carry trade unwind, and that has been kind of my argument about being a dollar bull for the last few months. If you've been watching this webinar every week, or this video every week, I've been talking about the euro being a funding currency, and if you start to see equity markets reverse course, then you're going to see the dollar probably come under continued pressure, where the euro and other trades that have been used as funding currencies might reverse course a little bit. That's why I think if you are short the euro dollar, you got to be very careful, especially as we come through these areas here. You see we're pushing right up against some resistance, so above 112 on a closing basis. And I've been suckered into this move before, as we've pushed into the 111.50 or 60 level. We close up here and we're like, okay, it looks bullish, and then it reverses the next day. I'd like to see a couple of days closing above the 200-day moving average or above the 112 level, and I might be more convinced that the euro has further to go. Probably the last line in the sand for euro bears is coming up here, because if you look at all these trend lines, I can just draw them for you really quick. We've broken some trend lines, and then your last final one right here through these highs, right here through these highs, comes in around 112.20, and then if we squeeze, and I'll just do some really simple fib work for you, some of those little Fibonacci retracement levels here. You think about like 38% retracement takes us to 115, 50% retracement takes us to 117. I don't think that these areas right here are impossible to achieve if a proper squeeze really takes hold, especially once we get above 113. Then you're going to start to see a lot of probably orders just start getting tripped from stale orders that are stale stop losses that are in place, and then you're going to have buy orders that obviously come in as well. So those are just things that I think that we need to pay attention to as we're going into this next week. Now, obviously, if this all coincides with the equity market selling off, then you have to start looking at pairs like the dollar yen, and which has failed multiple times at 109.70. We constantly, every week, I think we scratch our head and say, why isn't the dollar yen at 111, 112 with U.S. equities at all-time highs? And that is a big question mark that we've had as of late. And you look at this dollar yen, and again, I'll reiterate, look at how many times we've failed up here. Multiple failures up at this key resistance. I mean, we might be trading down at 107, 106 if the S&P gives back 5-7%. on a more significant pullback at the beginning of the year, which is entirely possible. After all these books have been marked up going into the end of the year, you might see some profit taking come January 1. Anyway, let's talk about a couple things that are happening next week. Obviously we have New Year's Eve on Tuesday and then New Year's Day on Wednesday, so the market will not be most brokers will not have quotes once you get into New Year's Eve. About halfway through the New York session, I believe that a lot of them will cut off their data feeds, and then they'll come back New Year's Day, late in the day for us in North America, because it'll be Thursday morning in New Zealand and Australia and Asia. So Wednesday night for those of us in North America, we'll start to see quotes again. But there is some data being released next week. We have Chicago PMI actually on Monday. Monday night we'll have China manufacturing PMI data out. Tuesday morning we'll have U.S. consumer confidence. That'll be the last piece of data for 2019 in the U.S. Last big piece of data. Thursday morning in Asia, or New Year's night, we will see manufacturing PMIs out of China. The private manufacturing PMIs, the Caixin will be released. On Thursday we have UK final manufacturing PMIs, and then on Friday we're going to have ISM manufacturing PMIs out of the US, and then FOMC meeting minutes. Okay, those are important pieces of data that are coming on Friday. Again, the liquidity is going to be kind of light, but that doesn't mean that doesn't mean for those of us that can be in front of our computer, we shouldn't be in front of our computer, and there might be some movement out there. So it should be fairly decent week, and let's all look forward to a more volatile 2020. I think 2020 is going to be a much better year for FX traders from a volatility standpoint. Now that we're pretty much past the phase one China-US trade deal, we got USMCA being wrapped up. We've got hopefully Brexit will be happening, and then we're coming in an election year. So it should be a fairly exciting year for as a currency trader. So once again, if you have not tried ForexAnalytix and you've been waiting to join the community, this is the perfect time to do it, right at the beginning of the year. And guys and gals, if you like this video, make sure you hit a thumbs up on the YouTube video, or if you're watching us on YouTube, make sure you subscribe to our channel so you don't miss any of our content. Also click the bell icon so you're notified via your mobile device or on your desktop when we do upload new videos and new interviews. And ladies and gentlemen, I want to wish you a wonderful and prosperous 2020, and I hope you're prosperous and you're healthy all through the next year and beyond. And my name is Blake Morrow with ForexAnalytix, and I want to thank you for tuning in every week, and we will see you tomorrow on the Face webinar. Have a great day.